Welcome to another episode of the Capital Spotlight podcast. Today I have Ron Diamond, founder of Diamond Wealth. Welcome on the show.
Thank you. Very nice to be here.
Good stuff. So let's go ahead and get started by hearing a little more about your background and also about Diamond Wealth.
Sure. Background, I got out of college. I went to Northwestern, worked at Drexel Burnham when Drexel existed. Drexel imploded, and then I started a hedge fund. So from 1990 to about 1999, I ran a hedge fund. We ran about 250 million. We were good stock pickers, but we had a lot of tailwinds behind us. Then I sold the company in 99, took a year off and started investing. And Diamond Wealth, what we currently do now, came out of that. Is I basically started investing, and my thought process was if I could put in X number of dollars into a deal, it might be a lot for an individual, but it's not going to be a lot on the cap table. So my thought process was that if I could, rather than me putting in certain dollar amount, and being the last or one of the last calls, what if I can combine that with other? Now, they didn't call them family offices back then. They called them rich people. So now they call them family offices. So what if I can get these family offices to invest alongside with me? So we could invest $50 million. I could put in 500 and the families could put in 49.5. I would get better deal flow and execution. That's the thought process. So it wasn't really a business. I wasn't charging. I wasn't making money, but it helped me a lot from a deal flow and execution. And I'm typically one of the first calls for many of the deals. So that was a thought process, and that's how we started. And then the company kind of morphed, because what I found was what we currently do is we represent about 100 single family offices. And these families range in size from 250 million up to about 30 billion. And what I realized is that just because somebody had that kind of money doesn't necessarily mean they're the most sophisticated people from an investing standpoint. Because if you think about it, where did these family offices make their money? Beanie Babies, Guess Jeans, Giorgio Perfume, 5 Hour Energy, chain of gas stations, you name it. They have a liquidity event and they're sitting on X number of dollars, $500 million or $1 billion. Totally different skill set to sell Teddy Beanie Babies. And I'm not denigrating it because I couldn't do it, but a totally different skill set to do that than it is to take $500 million, grow it to $1 billion, not spoil the shit out of the kids, do some wealth transfer, do some philanthropy, and grow the asset base. So what I found myself is, and then 10 years ago, all of a sudden, maybe 7 years ago, family offices became in vogue, right? So I found myself kind of at the epicenter of this family office thing. So what we do is we represent 100 families. We don't charge anything for it, but we basically look at just the private markets. I don't touch the public markets. We do private equity, venture capital, real estate, and credit. And I think it's much easier to create alpha in the public markets, where I made my money initially in the hedge funds. It was much easier to create alpha back then. And now I think it's much more difficult to do it. So that's basically what we do on a day-to-day basis. I also am in the board, and I teach at Stanford University in their graduate school of business. And I run 2 Tiger 21 groups out of Chicago. So that keeps me fairly busy.
Absolutely. So just out of my personal interest, could you share a little bit more about your career at Drexel and what the culture was like and kind of what you took away from that experience?
Drexel was awesome. Well, remember, it was my first job out of college. So I was 22. I'd never had a real job. So I got a job. And remember, at the time, and this is in the late 80s, I mean, Drexel was like Goldman on steroids. I mean, it was the most, it was a fabulous firm. They had incredible people, and it was my first experience. So it was an unbelievable experience. What I found was that after I left Drexel, there's never been another firm like that, ever. Now, I talked to friends who work at other firms. There's other wonderful firms, but the amount of energy, the amount of intellectual capital, the amount of I don't know, it was just such a positive vibe there at Drexel. 2 years into it, now I was a trainee, so I was like low on the totem pole. This was my first job. And we learned a little bit. They put us in different divisions. I worked in investment banking. I worked in trading. I worked in high yield. I worked in wealth management. And the thought process was you'd kind of do one of the things. And if it worked out, you'd hopefully run one of the divisions one day. Well, 2 years later, Drexel imploded. But I remember vividly Fred Joseph, who was a CEO of Drexel. Now, I was a trainee, and we had a class of 12 precocious kids who were just all, together. And I remember when they announced that they were going bankrupt, they were going under. And to me, it kind of sucked only because I lost a job, right? But at the end of the day, I didn't lose any money. I didn't have any stock options or whatever. But I'm watching these people in their 60s and 70s, like literally weeping. Like literally, they lost, many of them, not all, but many of them lost almost all of their money because they had it all in Drexel stock. And ironically, sadly, if you go forward, people made the same mistake with Lehman Brothers. People made the same mistake with Bear Stearns. So here I am, 23 years old, had the best job in the world. The company just went bankrupt, and I'm watching people in 60s and 70s crying because they lost their money. My takeaway from that, and which is probably one of the reasons that caused me to start my own business, is that I would always be loyal to people, but I would never be loyal to a company, because what is the company? It's the people. And if Drexel Burnham can go under, any firm can go under. So that's kind of was my takeaway. It was an incredible experience. I wouldn't trade it for the world. And again, we still keep in touch. I'm still very involved in Milken's Institute. I still keep in touch with a lot of former people from Drexel, and the amount of talent that has grown out of there, from Apollo to you name it, is remarkable. So it's a really good network, but just an incredible experience, an incredible place to work.
Very cool, very inspiring, and I'm jealous. So back to the single family office space. So you, like you said, work with over 100 families, and as your website mentions, specifically single family offices. So I think I might have an idea as to this answer, but why just the single family office space and not work with multifamily offices or even branch out to private equity funds and different pools of capital?
Well, good question. Different model, right? So the way I saw it was, and again, there is no right answer. I taught a course at Stanford, and I brought in 5 family offices, 5 patriarchs. They were all $1 billion families, and I asked each one of them. They were mostly in their 60s and 70s. Why did you create your single family office? And I asked them the question also, what is a single family office? And I got 5 completely different answers, and none of them were right and none of them were wrong. But what is a family office, and why are they created? The fascinating thing for me, and why I work with single family offices, the model itself doesn't work, right? 25% of family offices make it to the second generation, 10 make it to the third, and 5 make it to the fourth. So everyone wants to be a family office right now. It's become in vogue in the last 10, 15 years, but the model itself is broken. The reason we work with them is because I believe that there's a lot of things that we could do to help these maintain to second, third, fourth, fifth generation. And it doesn't have to do with investing in the best private equity deal or the best venture capital deal. A lot of it starts with governance. So what I like about it, it's very holistic. You have families that care. Again, I'm generalizing, but in general, families are more philanthropically minded than institutions. In general, family offices are more, their impact investing, is something that I never looked at the back of a can when I drank soda when I was a kid. Now you're younger, you do. That's what you get. So impact investing has become not big, but huge. About a third of the family offices are doing it. It's probably going to go up to about 50% of the family offices in the next 3 to 5 years. So I like being at the forefront. And I also think from the single family office, I think we're only in the first or second inning, because remember, these single family offices, many of them were just created, and they're inefficient, fragmented, and they work in silos. So what I'm trying to do is figure out a way to take, and they've got huge amounts of capital. There's close to $10 trillion in capital, but in inefficient hands in general. You could look at the Pritzkers, and you could look at the Dells, and you look at the Crowns. They've institutionalized it, so they compete directly with Apollo and everything. But most of single family offices can't. So what we do is we basically work with them. And again, I speak at a lot of these conferences. Nobody comes to hear me speak. They come to meet other family offices. So I think you've got a huge amount of capital in very inefficient, fragmented, siloed hands that's going to really change the way companies are backed going forward. for the next decade, 2 decades. And I think you combine that with the fact that you've got the largest largest distribution of wealth ever from the baby boomers to the next generation. It's roughly I think it's roughly $60 trillion. So at the end of the day, that money, it's the largest transfer of wealth ever. There's been more and more single family offices. So I love the fact that it's huge amounts of money, but very fragmented, and we're still in the early stage. And hopefully I can make a little dent in how this is how this plays out.
So earlier you mentioned the size of family office that you work with range from 250 million up to, I believe, 30 billion, which is a huge range. And I'm sure that they work and act very differently as the size changes. But what would you say is and based on that size of family office, what would you say is the typical check size or in your opinion, the appropriate check size as you're sourcing deals and structuring them with these families?
Well, let me start also by saying that a lot of these people will come to me and who have single family offices, and they shouldn't, right? They either don't have that. Look, I'm not correct when I say you need 250 million to have a single family office. And it's 250 million if you're going to invest in the public markets. If you invest in the private markets, which is your world, private equity, real estate, venture capital, you really need almost 500 million, because at the end of the day, you need a lot of really smart people to vet these deals and the deal flow, et cetera. So many people have these single family offices, but they shouldn't. They should just outsource stuff to a multifamily office. In the single family office space, what we found is once they understand, that they start with structure, they start with an estate planning attorney before they start investing. Then I kind of know who likes what. So on the deal size, to answer your question, I've invested as little as $500,000 into a deal, and I've invested as much as $150 million into a deal. Average would probably be about 20 million. And what we do is I kind of know who likes what. So if it's a cannabis deal of the 100 families, there might be 8 families that like cannabis. If it's real estate, which is your world, there might be 60. And specifically, if it's multifamily, there might be 30. If it's self-storage, there might be 10. So I kind of know who likes what. I invest in all the deals myself, and it helps me. I'm not doing it from an altruistic standpoint, because it certainly helps me, because I'm getting much better deal flow that I wouldn't see otherwise. And hopefully I'm one of the first calls rather than the last, and we get that. So that's kind of why I do it. And it's just been very, very beneficial. But that's about the average, I'd say about 20 million.
So let's dive in deeper into the deal structure. You mentioned that this started out as a solution for yourself, which is, I think, how many great businesses start out. Is just the founder is seeking to create a solution for themselves. And that's what you did. You found a way to be the first call, create better deal flow for yourself, and invest in larger deals. So in terms of the deal structure, are there, just dive into the control rights, the structure, the economics of it, how you get paid, how, what the family offices are looking for.
Okay. Well, first of all, I don't get paid. Now, again, I'm not doing this for altruistic purposes. I do get paid because I'm seeing deal flow that I wouldn't get otherwise. So we don't charge anything. So if you looked at what I'm doing from a Harvard Business School, they'd pick this apart and say, this is stupid. And perhaps it is. But I get great deal flow and I get great execution. So I think, and it's been a win. So that's kind of why I do it. We'll typically set them up in different structures. I mean, it could be in an SPV. It could be structured where you come in together as, one big LLC. There's different ways to structure it depending on what the deal is. But at the end of the day, when I've got, we can give a very quick no and a very quick yes. And when we give a quick no, that's beneficial to the people because we're not stringing them along. I'm just saying it's just might be a great deal. It's just not going to work for us. If it's a quick yes, we can execute pretty quickly. And one of the problems with working with family offices in general is that they're phenomenal partners, but they don't move that quick, right? They might be, well, we're going to Europe for a month and then we'll come back and do the deal. Well, you can't do that because the deal is going to close in 2 weeks. So I'm able to take care of that. So that's kind of how we structure everything. And it's actually worked out really well for the family offices. And it's worked out well for me because we're able to see some terrific deal flow.
Got it. Understood. So, and in terms of joint ventures, I'm assuming the structure isn't too dissimilar to what most people are doing out there in terms of, waterfalls and fees and things like that. What are some unique deal structures that you have seen get done and that maybe are unique to single family offices in terms of the way that they can operate it in terms of longer minded view and whatnot?
Well, first, you raise a great point. The biggest advantage family offices have is they've got patient capital, right? They don't have to turn their money over every 3 to 5 years. And I think the private equity and the venture capital model is broken. And this is one of the reasons why family offices are growing so quickly, exponentially. Um, it used to be when they just had public markets, the private markets were much better than the public markets because it all goes down to alignment of interest. So in the public markets, you can't run a company, in my opinion, well, objectively, every 90 days. So, and if you're a public company, you've got to report earnings to people like me who run a hedge fund every 90 days. And I know nothing or very little about your company. I just want to see earnings steady, earnings steady. So you have to manage your earnings. So the whole private market came out and it became a much better alignment of interest because at the end of the day, they started with saying, all right, we'll pay you 2% for the management fee and 20% of the profits, but only if you make money. So that was better alignment of interest. If you make money, I make money. That's terrific. And the 2% would pay for the overhead. The problem was they bastardized it and it became too big. And these private equity and venture capital firms realized that they can make the money on the 2% as well. And that caused a lot of things to make it less efficient. And you look at a venture capital fund like SoftBank, who's running $100 billion, you cannot place that amount of capital, period. And they've seen deals that were just, they have to place the money. The difference is with family offices, they could afford to be patient. So Jeff Bezos said, one of the advantages that he has is he looks at everything from a 10-year time frame, whereas institutions in private equity and venture capital firms have a 3 to 5 year time frame. So if you've got a 3 to 5 year time frame, you're competing with a lot of people. But if you got a 7 to 10 year time frame, you're competing with very few people. So it's not rocket science, and it's not that family offices are smarter than the other. It's just that they've got a longer time horizon. And the biggest way to create alpha is basically by structuring it like that. Compounding interest it makes a huge difference. You could sell the company at the right time when it's ready to be sold. And I think because of that, more and more people are looking to partner with family offices than ever before.
What would you say are some strategies or asset classes across venture, real estate, private equity that are most conducive to the longer term hold period?
Well, look, you're in the real estate world. I mean, real estate for sure, right? So if y- if you've got a deal and let's say it's a multifamily deal and you're compensated, not you personally, but your fund is compensated by turning money over every 3 to 5 years, you're going to look at it through the lens that you're going to want to turn it. Now, if it's a great piece of property, you might want to hold it for 10, 15 years. The funds can't do that. That's not how they're compensated. So I think that you're seeing huge amounts of people really come to start understanding the value of the family offices. Now the problem is we still are in the first or second inning. So it's still very early. So most of these family offices, the frustrating part is they might go to Europe for 2 months and not want to do a deal. So they just don't do the deal. It doesn't make a difference. So that's frustrating. It's hard to find these family offices. The other thing is family offices, they started because they felt burned. And again, so many, probably 50% of the family offices started since 2008. And when the market tanked, they felt there was not an alignment of interest. It's not the fact that they felt bad that they lost money, which they did, but it was how they did it. The hedge funds put up gates. The private equity funds did things, and they looked at it that the interests were not necessarily aligned. So the first, second, and third thing that family offices look for when they're going to partner with a sponsor is, can I trust you? And the fourth thing is, okay, what's your track record? Now, you look at it from an institutional standpoint, that's flipped, right? They'll look at your track record. How do you do each quarter? What was the biggest drawdown? Families want to be partners. And if you could find the right family office to partner with, they're the best investors because they're patient capital and not everything's going to work. but the intent and the alignment of interest is there at the beginning, and that's what makes the biggest difference.
Interesting. So going into further into due diligence, you mentioned trust is a big one, which I think that is less formulaic to develop, takes a lot of time. Track record is pretty straightforward. What are some other deeper dive due diligence things that you guys typically do when you're vetting a sponsor and you're vetting a deal?
Well, we've got a team of people who help me now to vet the deals. So I can't be an expert in everything. I'm really an expert in nothing. But what I've done is I surrounded myself with people that are smarter than me in different areas. So if it's venture capital, I partner with a guy named Michael Loeb. Michael is the founder of Priceline, Synapse, and dozens of other really successful companies. So I'll let him kind of work. I'll work with him and I'll let him help me vet these deals. In real estate, I try to find people who are best in class, and then I kind of let them do what they know how to do. And it won't just be somebody who's an expert in real estate, because that doesn't make sense. You could be an expert in multifamily. You can be an expert in student housing. You could be an expert in industrial, whatever it is. So what I've been fairly thoughtful about is finding best in class in those areas, delegating, partnering with them, and working the network. So again, my whole business, if you ask how has it become, somewhat successful, it's all based on relationship, 100%.
So speaking of relationships, obviously one of the most important parts of this type of business is deal flow. And you mentioned before, deal flow was a big thing for you and why you wanted to pursue this. So talk about kind of deal flow that you were working on before Diamond Wealth, and that felt limiting, and then how you actually went about building the relationships both on the family office side as well as on the operator side to create this robust deal flow.
Well, it's serendipitous. I would love to say I had this great vision, but I didn't. I mean, so I when I sold my company, I'd invest money. So if I put 500,000 or $1 million into a deal, that's a lot of money. For an individual, it is, but it's nothing on the cap table. So if I come to you, if you're raising $200 million for a multifamily deal, and I say, hey, I'm going to invest $750,000, that's great, but it's like a non-event, right? For most of the sponsors. What I found is, and where I see a lot of what we've done is, we've become the anchor investor for many companies. And as the anchor investor, sometimes we can negotiate, and sometimes we'll take a part of the GP. Sometimes, we could structure things differently. So I think that the way in which we structure things and see things. So I initially thought that, 500,000, wow, it's a lot of money. And it wasn't. So I quickly realized that, let's get these other, again, they didn't call them family offices, they called them rich people. So let's get these other rich people together and syndicate the deal out. And then it's just common sense, right? So now we've got a reputation where, again, I'm not saying we're the first call, because, perhaps we are, but we're certainly one of the first calls, because we could place a large amount of money in a very short period of time, very efficiently, and we're good to partner with. So that's, I think, why it happened. And it's just been a very effective model for us. And it's worked out really well, certainly for me and certainly for the clients I represent. Not every deal works out perfect, but they're thoughtful, and they're well thought out, and the alignment of interest is there. And that's really the critical part of it. It all has to do with alignment of interest. And that's why these family offices have grown so much. It all comes back to alignment of interest.
So what type of operating partners are the best fit, or that you're seeking to partner with and your clients? Is it an institutional sized partner? Is it a, non-institutional size? So what's that ideal partner for you guys?
Good question. There's not a specific size. So it's really the people, right? So it doesn't matter if it's small, medium, or large, whatever that means to you. It's just that we're partnering with the right people. So if we've got a sponsor that we trust, and they're really good people, and we think we can partner with them. Look, these are people I want to be with for 20, 30 years, not to do one transaction or two transactions. And if this transaction doesn't work out for whatever reason, I'm never going to do business with them again. So we look very carefully at the people. And again, I think the success to what we've had is 100% based on the relationships that we've created. Now, I'm not perfect as far as, picking the right partners, but we're very thoughtful in who we decide to partner with. And because when things go well, it's very easy for everybody to go give a high five and say, hey, look how great we're doing. To me, a partner is what happens when something doesn't go well. Are you communicating? Are you talking to us? Are you working it, et cetera? And how do you, and that's really where character comes out. So I'd say that's where we do the most due diligence, is as far as working with people. And how do you get to know people? I mean, there's a whole bunch of different ways. Obviously, you're going to meet somebody for the first time. You'll have an impression of the person, but then you could also talk to some of their suppliers. You could also talk to some of their people who work for them. I mean, I will never work. There was one real estate family company that had an incredible track record, but they treated their employees like shit. And I'm like, I would not work with them. Now, I probably missed out on some good investments, but I don't want to work with people like that, because if they're going to treat their employees like that, I'm just a partner, right? So what are they going to do to me? So we're very thoughtful in how we structure and who we work with.
I like those points a lot. It sounds like you're taking a few questions from your DDQ and, sharing some of those good due diligence questions. I like the idea of focusing not on, because when you look at a track record, right, the aim is to portray it in the best light possible. But I think where you glean the most insight is when you focus on when things went poorly. And so I think asking questions like, we'll talk about your worst deal and talk about what you did to fix it, and talk about, a time where you had a partnership dispute or some sort of issue, and how you went about resolving it. Is that something you guys have discussions around?
Yeah, and we do. And look, everybody, it's very easy to have a canned answer to talk about your worst deal and how did you work it out, and everyone looks good. But really, where you could do the diligence, I think, is, I was with one family, is a real estate family, and I was riding up the elevator with a maintenance guy, and they're like, "Oh, you're going to Mr. So and So's office. He's such a great guy. He always whatever." Well, that to me is diligence, right? Here he is treating the guy who runs the elevator extremely well. That says a lot to me. That's a huge part of. I'm not going to invest with him because of that, but because this guy told me that, and he didn't matter to the other person, that makes a big difference. And at the end of the day, look, I do believe when I was younger, I used to think what I want to do is work with only the smartest people. But what I've realized is, and I see this at Stanford, intelligence is a commodity. I mean, there's a lot of really bright people. You need to have people who you can trust. So if you find the intelligent people, but people who you can trust and you're comfortable partnering with, that's where you're going to create alpha.
I like it. So let's wrap up the conversation focusing on the more ancillary parts of your business, which are the advisory and the estate planning and things like that. So to start off, let's discuss the investment banking side of your business.
Right. So basically what we've done is, what we have is we've got relationships, right? So I've got access to a lot of extremely wealthy families, and these very, very wealthy families look at me as a trusted advisor. And some of the family offices we work with, if you're working with people who are worth $1 billion or more, there's different parts of the family. So they might want to do a dividend recap for one of their portfolio companies. They might want to sell a company. They might want to buy a company. So we've developed relationships with them where what we'll do is we will vet the different investment banks. And if somebody's looking to do a dividend recap, or somebody's looking to do a sale or a purchase or add-on, we kind of know who likes what. So again, what I think the success of Diamond Wealth has been is totally a function of my being able to surround myself and doing a really good job with best in class people, having the trust of the families that work with us, and then just executing from that standpoint. So if somebody's looking to do in cannabis and they're looking to do a sale of a company or an add-on or a financing, which is really hard to do right now, um, I've been very thoughtful about who is that person, who is that company that I would partner with. So our due diligence, we're really good in our diligence, but we won't be better than a lot of the other firms as far as how do you diligence a deal. Right? We're thoughtful and we do everything, we check every box. But where we I think are better is that we spent so much time developing relationships with the right partners and the right people, and that in and of itself I think makes the biggest difference. That's the alpha that we create.
So I don't want to open up a new huge discussion, but you touched on governance early on, and wanted to go back to that because I think a lot of people, when they do anything, they just want to dive right in and they forget to set the things up and actually, kind of set an intention, set a mission statement, and things like that that are going to lead them throughout that process. So can you just quickly discuss what governance is as it relates to family offices?
Yeah, and remember the reason it's so important. The first thing I said, 25% of family office make it to the second generation, 10 to the third, and 5 to the fourth. So the model itself doesn't work. The first thing you want to do when you have a liquidity event, people say, okay, I want to invest. I want to do a private equity deal or a real estate deal. That's not the first thing you need to do. The first thing you need to do is the most boring thing. Go to an estate planning attorney and structure things properly. Because at the end of the day, if it's not structured properly, you could have great investments, and when it gets to the second or third generation, it's not effective. Having said that, if everything's structured properly, that makes a huge difference. So what we do is I encourage the people, look, I'll be able to show you deals. You'll get great private equity or venture capital, I'm on the board at Stanford, so I see early stage deals. That's easy. That's not complicated. But you want to invest from the right standpoint. And at the end of the day, I remember that when I ran my hedge fund, there was a very wealthy guy in Chicago, and one of the questions I had to ask the net worth, and he said 0. And I said, no, seriously, what is it? And he said 0. And then he kind of patted me on the back. He said, you'll learn about this one day. And what he explained to me is, the goal is not to be worth $1 billion. The goal is to be worth close to 0, but control as much as you can. And this whole trust and estates planning attorney, the whole market, that's basically what they do. So so when somebody is on the Forbes 400 list and then they come off, it's not that they had a bad year, probably because they could have had a bad year, but it could have also been they've done really good planning. So I understand the importance of that. And we're a very litigious society. You want to have asset protection. You want to have trust set up. So unless that trust, it's like the foundation of a house. Unless that house, the house on top might be great, but if the foundation isn't there, it could fall apart. Once you've got the foundation built and thoughtfully executed, everything else is gravy.
I love that. That's a very cool story about the 0 net worth. Well, that pretty much wraps it up. Really appreciate your time. Thanks for coming on the show. Let listeners know the best way to find out more about Diamond Wealth and get in touch if there's a reason to.
Sure. They could, my email is ron@diamondwealthstrategies.com. And they could also, we have a podcast where we talk about family offices, family office world podcast.com. So either one of those two. But I'm happy to talk to them.
Sounds great. Okay. Thanks again.
Thank you.